There is a hidden pattern overlooked by 90% of traders. Once you learn to see it, you'll understand why price moves exactly the way it does. My guarantee is, once you understand this, you will never look at the chart the same way again. The market does not move randomly. It consistently follows a repeatable and predictable cycle. This 100-year-old methodology, first discovered by some of the best traders of our time, such as Wyckoff and Jesse Livermore. This is the master pattern. This pattern is one of the most consistent forms of technical analysis, overlooked by 90% of traders. It allows you to understand the three market phases. The contraction phase, where price tightens and the buyers and the sellers become equal. Then when price breaks out the box, it goes into the expansion phase, where we get this whipsaw above and below the value line. And then once price whipsaws above the value line 3 to 7 times, it moves into the trend phase, which is the profit-taking phase. This pattern shows you the best places to identify buy and sell positions. The traders who understand this will have a massive edge in the market because they will be able to identify the best places to look for longs and the best places to look for shorts. Let us now dive deeper into the three phases. Phase number 1 is the contraction phase. This is caused by low institutional volume. Then we get phase number 2 is called the expansion phase. This is where we get increasing institutional volume. The range starts opening up, taking out highs and lows. And then we get the third phase, which is the trend phase, where the market makers start taking profits on their accumulated positions. Phase number 1, the contraction phase, is where we get a tightening of price. Then we get phase 2, the expansion phase, where we get a widening of price, an increase in volume. And then we get the trend phase. It is the move to higher or lower prices. The three market phases repeat endlessly across every time frame and in every asset class. It all starts with defining value and understanding contraction. Understand the first phase of the market and how it is determined. Pay attention when you see the simultaneous higher low and lower high forming. When you get the buyers and the sellers becoming equal. Phase number 1, the contraction phase. It is a squeezing of price. This is where you see price will oscillate and then you will get a simultaneous lower high and higher low forming. It can also happen on any time frame, on higher time frames and lower time frames. This is a leading incoming volatility signal. It tells you what is going to happen next. As you can see on the chart here, we get this expansive displacement to the upside. Then price forms the contraction phase. We get a simultaneous lower high and higher low. We draw a box around that. Then we get the value line projected out the center of the box. Now we can identify where contraction is starting and where the value line is projected outward from. This gives us a barometer to understand where is value located on the charts. Contraction leads to defining value. Value is also known as the contraction phase. It is the future tipping point between the bull and bear markets. So you can see once we get contraction, we get the value line that is projected outwards. When price is below the value line, this is where we want to look for buyers. And this is where the market is oversold. When price is above the value line, this is when the market is in an overbought territory. Contraction helps you define expectations of upcoming market behavior. Contraction provides you with the market maker's starting accumulation point for their book of business. The contraction phase is the start of the market cycle. So you can see here we get the contraction phase. The contraction box is created where we get that lower high and higher low. Then price expands out the box and goes into the expansion phase. This is where we get the expansion line projected out of the box. This lets you know we have this incoming volatility that is starting to happen. Contraction is a leading indicator and it lets you know that expansion is about to happen. First, price goes into contraction. It contracts into a tighter and tighter squeeze point. Then eventually there's this explosive movement out of the contraction box and we get expansion. So contraction lets you know that expansion is coming next. These contraction lines become extremely strong friction levels and framework structure to give you a point to work off of. So price can approach these value lines and they can find resistance at these points. They become excellent places to look for entries or to look for your exits, especially higher time frame value lines. These are magnetic levels. These levels provide us with the point of control for the market makers' significant levels where they manage their book of business. Wherever contraction is located, we get the value line projected out of the center. That value line becomes the point of belief in the market where we get this 0 point identification level. This is where the market maker's book of business is at 0. If you want to learn more about the master pattern concepts, click the link below to access a free trial to my new improved TradeATS system, courses, and tools. And then we get the second phase, which is the expansion phase. This is where we get the whipsaw out of the contraction phase. So price goes into contraction, and then we get this expansion out of the contraction box. Price will oscillate around the value line multiple times when it goes into these multi-leg expansions. This is specifically created to manipulate the masses in the market. As you can see here, price goes into contraction and then we get expansion above and below the value lines. This expansion is designed to liquidate, confuse, trick, and manipulate. This is the point where the market makers accumulate their massive position sizes before they decide to move the market into the trend phase. This is this whipsaw action, which is designed to liquidate the masses to fill their orders with their large liquidity. This pattern was specifically created for this effect. Once you know price is in the expansion phase, you can trade it as if you know and understand it's in the expansion phase, which gives you a massive edge. As you can see here, we get contraction, the blue box, which is our balance point in the market. We get a value line projected out of the center. Then when price is above the value line, this is where we want to start looking for sell positions. The further price extends away from the value line, the greater the possibility it's going to come back to the value line. So when price is below value, we get a buying pressure. This is where we want to look for long positions. When price is above value, this is where we get the selling pressure. This is where we want to look for our short positions. And then we get phase number 3, the trending phase. After you get this whipsaw movement, which tricks the masses to make a wrong decision, then smart money settles on a trend to move the prices higher or lower. So we get contraction, expansion to liquidate, and then when the market makers have accumulated and filled their position sizes, then they drive the price higher or lower into the profit-taking phase. But the million-dollar question is, will the trend phase go up or down? If you're able to predict the trend phase, it will literally be like printing money. But this all depends on the higher time frame bias. It all depends on your ability to determine the bias of the market. If the market is in an uptrend, then you know you're only looking to enter long positions when price is underneath the value lines. When price is in a downtrend, then you're only looking for short positions when price is above the value lines. This gives us a super clear barometer and understanding of when and where to enter. The market is always in one of these 3 phases. In the uptrend phase, we get phase 1 contraction, phase 2 expansion, which is our accumulation phase, and then phase 3, the trend phase. Once we get price go through these 3 phases within the accumulation cycle, then eventually it will reach a point where we start to get our downtrend phase. We get phase 1 contraction, then phase 2 expansion into the distribution cycle, and then we get phase 3, the trend phase. That will be our completion of a 3-phase cycle within the distribution cycle. So if you understand these three phases that are happening within this framework, can give you a very good structured idea of how the market is moving. The key is to practice marking out the contraction boxes and the expansion lines on your chart. Step number 1, mark out contraction with the box. Contraction is when you get a simultaneous lower high and higher low happening. Once you can identify that higher low and lower high, you mark a box around it, and now you've identified your contraction box. Then step number 2, you want to draw out your expansion lines. Once you've identified the contraction box, all you need to do is mark out a value line out of the center of the box and extend it outwards. This becomes that all-important point of control level. As you can see, we get contraction, and then we get the value line drawn out of the contraction box. When you know where value is located, you only want to enter longs underneath value and enter your shorts above the value line. This is the market maker's strategy, and most retail traders do not understand this. Most retail traders buy above the value line and sell underneath value, which is the wrong way to do it. So we want to do the opposite of what the retail traders do, and we want to synchronize your strategy with the strategy of the market makers. Without the indicator found below, learning how to master marking up these hidden levels by hand is essential. Make sure to watch this next video now, where I show you step by step how to mark out contraction boxes and expansion lines. Click to watch the next video now for a deeper dive.